But what everybody wants to know, the 90-day past due loans, why we're increasing the provision for credit losses, is the economy collapsing, baby? Well, let's take a look. Today, folks, I had to use the red backdrop because Bank of Nova Scotia is crashing yet again. We're not retesting those 52-week lows, but in my anticipation, there's a chance that we could based off these recent earnings, and we continue to see the same kind of trend that we've been seeing from the prior quarters. In this video, we're going to break down everything you need to know about Bank of Nova Scotia. We'll break down some of the dividend details and dive right into these recent earnings. And if that is a conversation you'd appreciate, as a dividend, a passive income lover, as always, consider hitting that like button, folks. But take a look at this, because Bank of Nova Scotia stock, if we just zoom in on today, it's right now trading down about 4.6%, starting to hover a little bit flat. Again, we're not really retesting these 52-week lows. There's still going to be a good chance that October was the bottom of the market, but these earnings, they're a defining factor to a continued deterioration in earnings per share. And we'll take a look at that because the PE ratio seems to be hovering around 9, and we're getting back up to a 7, almost 0.4% dividend yield. And as mentioned, the earnings are the primary dictator of what this stock does, because if we take a look at the net EPS, this chart really resembles what Bank of Nova Scotia's stock chart looks like. And again, it looks like it is continuing to deteriorate based off the fact of loan loss provisions. They're having higher expenses, even though they're sitting in a place of record revenues, which is just utterly fascinating to me because it's a sign of the times, and there are risk buying these banks. However, I am buying them through VDY, my Canadian dividend ETF that gives a bit more diversity and is kind of removing that volatility, but I'm still debating on whether I want direct exposure to these banks on an individual level or even through just a sector-focused bank ETF here in Canada. But taking a look and comparable to Royal Bank, and why Royal Bank isn't getting hit nearly as hard is because Royal Bank on its last earnings was able to show a flatlining in EPS, which means if they post something similar to this earnings, it's likely their stock price isn't going to move really much in either direction. But taking a look at Bank of Nova Scotia's 5-year growth rate for its dividend, it's sitting just around 5%. I mean, this thing has been just utterly amazing over its long period of growth through many recessionary and stock market crash like environments. Its payout ratio, I think, is a bit higher than this. I think it's around 58% as it stands today. But again, we're getting an amazing grower of a dividend yield here. Now, there are stocks that grow their dividend better, but when you're talking about starting with over a 7% yield, I mean, that's damn near a market return as it stands. So if the stock is able to recover and we're able to get out of this tougher market environment and we get back to a nominal level, and again, I've talked about this, on my recent live streams, is that this is unusual. This isn't going to persist. We're in the middle of it now, but I'm thinking we're starting to see the tail end of it, depending on what the interest rate cut cycle is going to start looking like. And that could still be in the second quarter of next year. We're going to have to wait and see. So that means we're still going to experience a couple rocky quarters here, right? But I think if you look out 1 to 3 years from now, that we're going to see a recovery in this. This is a very unusual time, and we can start actualizing some of those revenues in the future. It's likely we're going to see an outsized return not only in the stock price, but again, then we can start seeing a recovery in dividend growth, because something tells me the dividends aren't going to be growing much when they're continuing to see a decline in earnings, right? So nonetheless, it's a very intriguing value setup for a company like this. And just taking a look right now, the total revenue, as mentioned, you kind of got to zoom in here, but you can see it's about $8.3 billion, and it consecutively has been growing quarter over quarter, pretty much year over year. If you take a look at the year to date, $32.3 billion versus $31.4 billion, but with the provision for credit losses continuing to expand here at $1.2 billion, which has gone up dramatically over last year. This time last year, to put it in perspective, was $529 million, where a total this year sits at $3.4 billion versus $1.38 billion basically in 2022. I mean, it's a 100% increase year over year just on the provision for credit losses. You're not seeing a real change in the diluted shares, which is very nice to see. And taking a look at the book value, continues to remain stable here at about $56.71. And currently the stock value again is about $57.44. So we're trading right in line with basically the book value. You're basically paying the fair value for this company where it sits today, which is also very intriguing. If you take a look to employees have been declining dramatically. You can see they've been doing mass layoffs. Branches have actually been declining here pretty dramatically on a quarter over quarter basis. You can see they're cutting costs, which is what you would expect in this market environment. But what everybody wants to know, the 90-day past due loans, why we're increasing the provision for credit losses, is the economy collapsing, baby? Well, let's take a look. First and foremost here on the mortgages, we can see from basically Q1 of 2022, it was 0.12%, basically when we're talking about 90 days past due, and now we're sitting at about 0.16%. And as mentioned, it's fascinating that mortgages are not the defining factor of this crash. It's kind of mind-blowing that, yeah, in this crazy mortgage real estate environment, that mortgages have not severely increased in kind of these 90-day past due. Whereas if you take a look at like personal loans, they've gone from 0.44% to 0.69%. Credit cards from 0.69% to 0.7, like hardly unchanged. If you kind of just take a look at like secured and unsecured line of credits, that's where you're seeing the biggest increase. I think a lot of this could be related to businesses, 0.17% to 0.29%. So that's a big jump. I mean, that's a huge jump. But in total, from 0.17% to 0.25%. And again, a lot of this primarily just being driven by the secured and unsecured line of credits. It's hard to tell like how bad the economy truly is here. If you take a look at international, again, even with mortgages in their Latin America kind of portfolio, really not that bad, from 2.2 to 2.39. Personal loans going from 3.33 to 3.78, and then credit cards at 1.88 to 2.95. And again, we're not where we were in the pandemic, but if this continues, it's not a trend we obviously want to see, because this is what's making the loan shakier. This is what's leading to the higher provisions for credit losses. And we're going to take a deeper look at that, but look at the Canadian banking side, because net income was down 31% because of provision for credit losses, where revenue was up 6% because of the net interest income. And as mentioned, the higher interest rates go, the more it bodes well for these banks. The global wealth management net income down 10% because international wealth management, though, was up 7%. So international is doing a bit better, with revenue again up 3% because of higher brokerage and advisory revenues. Expenses were also up 11%. When you take a look at global banking markets, net income down 14%, but revenue in line with the prior year. The expenses were up 12%, driven by higher basically personnel and technology costs to support business growth. It would seem there's some aspects of international doing a bit better, but net income down 20%. Again, revenue up 3% because most of it being driven by net interest income yet again. And then you got some other highlights here. But again, what's most fascinating are these provisions for credit losses. And this is what everybody is most intrigued by, which if we take a look just for basically all banks, the entire sector, impaired went from 494 million to 802 million, and with performing increasing pretty dramatically. But all in all, total was sitting at 1.25 billion. Canadian banking alone went from 153 million to 286 in total, 163 to 700 million, which is a rapidly large increase, especially on the performing side. You got international banking here, again, doing fairly well all in all. Total went from 355 to 512. Either way, these are all trends we really do not want to see. Higher quarter over quarter, driven by performing provisions built due to unfavorable macroeconomic outlook and continued uncertainty from higher interest rates on portfolios. Primarily seems to be coming from line of credits almost, in probably the business segment, as small businesses probably continue to get wrecked, as they are the ones that can't keep up with this environment, right? It's not necessarily mortgages, but as mentioned, like Walmart, all these big conglomerate companies, when they increase minimum wage, which is what we're seeing, right? Walmart doesn't care. They can increase margin, they can do whatever it takes. But when you look at a small business, if minimum wage goes from say $15 to $20, as just a random example here, small businesses can't really make up the margin difference, right? So it's, they're the ones that are truly affected, and they are part of the backbone of the economy. And we're seeing the most stress, in my opinion, outside of everything else that's based on these banking earnings. So again, I'm just saying these are not as terrible as most people would want to make them out to be. And I think this is going to be a continued trend, and we're looking for that shift when that change comes. And I think it's not really going to come into full effect until, one, interest rates level off, which we're seeing. So we should start seeing, this bacon effect start to find a leveling at some point in the next quarter or two. And then hopefully by then we get into the next interest rate cut cycle, where we start seeing the rebound in the earnings per share, and we start seeing a better effect on these banks, where it returns to somewhat of a normality. And that's when I think you're going to get the outsized return. I'm not talking about tech-like explosive growth here, but if you can lock in a 7% yield that remains to be stable, the economy doesn't completely collapse, which we're not really seeing a true sign of, and we get back into a recovery, you're going to see an outsized return in these banks. I'm very confident in that, which is why I'm taking positions and trying to buy them a bit more aggressively. But this is just one man's opinion. I'd love to know what you think in that comment section below.